Thank you for joining my regulatory webinar today about Basel III on or4 and the capital requirements. So the thing is that it's always people ask me, what is it now, Basel III, 4, and so on. So right now the wording is like this, that the implementation of Basel III as we speak of 2019 and 20. It's called Basel IV actually because people lose track and there's no official statement towards that. So the Basel Committee always publishes something towards their own regimes. And at the moment, the wording is like this, that they speak of Basel III implementations. So forgive me if I, mix it up or just call it Basel III at the moment. This is not let's say important. Important is the content and what it is all about. Okay, so and I will tell you that, and I will tell you also what has happened in the past months regarding the crisis. And I think this is all very important to see how the different measures and regulatory measures change over the crisis, but also have a certain impact. That's quite interesting. Okay. So we'll start. I will give you, here is the agenda. I will give you first an overview over the timeline. Of course, first of all, the highest committee, which is the BCBS, it's a global committee for the Basel regulation. It's here, they have on the 20th of March this year, immediately, relatively quickly, when the crisis became apparent, published immediately revised implementation dates for their main regulatory cornerstones, which is listed here. You see that basically all these cornerstones have been postponed by 1 year. Even that was quite, let's say, put some smiles on the faces of regulatory, let's say, experts like me, because there was, even before the crisis, like in December, there was already discussions about postponing these dates. So I think that in the light of this, I think a lot of people thought, okay, that came in handy. Of course, nobody makes jokes about this crisis, but in terms of coincidences and certain developments on the regulatory field, there was a very clear match of interests here in this case. But nevertheless, you see here some important implementations mentioned, namely market risk framework. I will say some words towards this. Of course, I cannot go to all the details this in this 45 minutes of my presentation. I will basically give you a real core CRR2 impact, and basically also what is my intention to tell you the impact on your regulatory reporting and on your risk work regarding the CRR2 capital requirement regulation. Okay, so first of all, of course, when the big global Basel committee reacted, it went down to the European Central Bank and the European Banking Authority. Immediate reactions, I listed here some of them that are quite, let's say, significant for the banks. Of course, there was a strong recommendation not to pay dividends in terms of the crisis and in terms of the expected credit losses and expected bad impact on the whole economy. That was basically the main fears was that we have a kind of same scenario than 2007 or 8, where a massive break of collateral and a massive default of credits would cause a chain reaction in a lot of ways. Okay, so what we have here is also the immediate, let's say, mitigation activities here. There was a postponement of the EU-wide stress test, of course. There was certain IFRS 9 and forbearance and default measures. This statement was from the EBA also relatively early that was in March, end of March. And also we had here, end of March here, the view on operational reliefs, where I will go a little bit more in detail later on the supervisory reporting. Of course, operational reliefs come in also very good for the banks, because exactly there is then also the problem that suddenly all plans are stopped, and things like availability of resources and also activities for reporting are secondary in the face of crisis, where you need to really get your head around certain things like credit risk and defaults and certain other important figures. Okay, so here we come more to, let's say, more kind of more detailed analysis of all these different measures. I will now list some significant changes to the CRR that have been published then by the EU Commission, also directly as the consequence, but of course after the, let's say, quick activities or quick reactions or recommendations that have been spoken out after that. Of course, they needed kind of a more clear way on what to do. What they the first did, of course, were here in the IFRS 9 transitional provisions, soften the expected credit loss, ECL here called, on regulatory capital. So it was here amended, sorry, got here. And these provisions, this amendment also, of course, was then, that was more important, completely excluded from the own funds calculation in 2020 and 2021. So this is quite, let's say, what does it mean? It means simply that you have certain defaults that will come in that you can then postpone from the reporting. That means simply that your figures will look better, although in reality you have a lot of, let's say, outages and defaults and credits that are not paid back. And it can be here concerning the own funds impact phased over in 3 years until 2025. So actually it is not really, let's say, a reporting that would really just omit figures, but it will be just reported later, and you can then stretch these losses. Of course, this is, let's say, a very short-term measurement, because we don't know what's to come in these following years, but it can, of course, has at least an impact on all the capital requirement calculations and reporting, of course. And we have here quite, let's say, that has a deeper impact, of course, on a lot of calculatory calculations regarding the CRR figures. Okay, so even I write here, even if banks do not use the IFRS 9 transitional provisions, what does that mean here? The allowed they are allowed to reverse that decision. That means simply that the reporting that has regarding the IFRS 9 provisions. I have to start again. Okay. the consent of the competent authority is needed when you even when you don't use the transitional provisions. You can let's say you don't have to use the new regime, yeah, so that you can have an excluding of certain provisions that were already in place. Yeah, okay, so that means the transitional provisions are things that you can use right away. They don't use an extra consent, but these even if you say, okay, I don't use these provisions, you can really go back and say, okay, I will, for example, for calculating my IFRS 9 figures, I can use older and let's say less restrictive calculations in order, but you take this only with the consent of competent authorities. Okay, sorry, that was a bit complicated here, but this is, let's say, a kind of a little backdoor solution that they built in. So what was meant was that in 2017, they had the last IFRS 9 provisions that were valid, and you should then reuse these 2017 regime instead of the actual one. Okay. I can give you, by the way, also some links after this presentation where you can read this in detail. So these kind of regimes they go quite far, and of course I cannot, let's say, bring you all these details in to your knowledge in such a, let's say, short time. But of course I can give you all the backgrounds later that you can read it for yourself. Then the next parts are here: loans guaranteed to the public sector, quite interesting also. They have then receive a preferential treatment in the calculation of the non-performing loans backstop. So what does that mean? That means simply that you that a certain if you reach a certain limit for non-performing loans, of course it will bind more capital, and if you can, let's say, have then certain preferences on certain loans that you can use as such, so that you get guarantees from public sectors, although they are non-performing, you can exclude them from the calculation of this backstop limit. That's what it's meant. That means also it will ease your let's say, it will ease your limits that you will not reach them too fast in terms of loans that are done on the public sector. Several measures here implemented as part of are beneficial for banks that will be implemented earlier than foreseen. That is quite an interesting part of the measures, because we don't only postpone things, also they take things earlier in consideration. Why do they do this? Because they, of course, help and support, especially here, the SME factors, the smaller banks. I speak of the so-called measures that help the small and middle class entities, and also here the infrastructure financing factor. It is very clear that the so-called for smaller banks, of course, the so-called proportionality is very important. When all these CRR measures came, they said, okay, this is good for big banks or tier 1 banks, but not for us. And so a lot of banks try to get this helping or supporting measures earlier in place. And I think this is it's a very good thing, because when you look at the structure of the markets, you have these. This is really good for a lot of middle class and smaller banks, and or foreign banks, for example, that have only smaller branches, so they are not as impacted by certain regulations. It is also, for example, here infrastructure financing factor, and the deduction of software assets. That, what does that mean? That means simply that when you have certain assets that are not very liquid, but you have them in your books, and you can, for example, especially for software assets, you can use them as means of helping you in the books. That means that you can earlier write them off, or you can earlier put them on the spot here and help you getting your LCR done. I will have quite a nice sample for that later on in the next slide, I think, and then you will become clearer with which kind of buffers it helps to mitigate. Okay. So these measures, all in all, were especially good for, let's say, the smaller parts, and then you will see what has been done as for the bigger, let's say, leverage ratio calculation for certain scenarios. Okay, yeah. So the binding minimum requirement for the leverage ratio introduced by the CRR2 was changed also with for the treatment of central bank reserves. That means also that the so-called reserves have been kind of not suspended, but significantly put down, so that also your bound capital was freed, and that certain capital reserves, let's say, are available for the banks as well. So all these measures, of course, should bring some relief. Yeah, and also we will see that this relief is in certain scenarios not wanted when we speak about some diligence. Here is in general a very good overview. I got this overview from Pricewaterhouse. Thanks to them, they have here listed quite a good so-called 3 corona buffers in the making of the capital or calculation of the capital requirements. When you see here on the bottom, the classical 3 parts of the minimum own capital that you have to collect, and then on top of that other financial requirements that come, of course, in the wake of Basel. And then when you see here on the right-hand side, the adaptation of regulatory capital due to the crisis, you see 3 different parts that have been significantly changed. Yeah. They have not completely been, let's say, been avoided, but when you look at the simple smaller parts here, you have here the Corona Buffer 1, which is the where you can operate temporarily below the level of capital defined by the Pillar 2 guidance, the P2G. I will not go into the detail here, but what it is, it means simply that you can for a short while go under certain limits and still be operable, or still do the intended activity. But of course, it's always connected with a higher amount of diligence and a higher amount of documentation. Here, the Corona Buffer 2, this is the countercyclical capital buffer. This is also a relief for certain capital buffers you have to keep, and this is then significantly lowered. For example, well, in Germany it was only I think 0.25%, and they have lowered it to 0. But the United Kingdom, for example, they had 2% here, and they also put it down to 0 for the next 12 months. This can change, of course, but it is a big help at the moment. Then we have the Corona Buffer 3, which is the conservation buffer. This is also kind of just a fixed buffer that is then also, let's say, suspended for a certain time, at the moment also 12 months. You have here, I mean, these are, let's say, the main 3 Corona buffers, but of course we have a whole bundle of certain measures here. Okay. Well, anyway, I hope this shows you a little bit where the CRR regulators here, or the ABA, tried to, let's say, really help with some comprehensive changes in the CRR. So now I come to the more, let's say, the turf where it comes more to the operational part, where we speak about monthly, quarterly reporting, where we speak about certain tasks that really kick in. Here we have liquidity, AMM, and NSF. Basically, I also will mention some others, but I found it very interesting that the regulators said here that we had lessons learned from the crisis 12 years ago. Because banks fail, they run out of liquidity, and what shall we do? They said, okay, here we cannot let you go here, of course, and so they have stressed the importance and said, okay, we need, of course, timely and very closely even observe the liquidity. And because actually, you know, the regulator said very clearly, okay, we give you some measures to improve or to work against the impact of the crisis, and give you, let's say, here more buffer, there more buffer, and there put some limits down. But at the same time, of course, you must even more so, very diligently report and be very, very clear about this, and be very, let's say, of course, they look at this, and therefore it's important to know that certain things have not changed at all. You know, so the EBA said very clearly here, that was also end of March, that LCR AMM reporting is a priority, and it will not extend it, or it will not even postponed. The same was then regarding the data point model for the European, for the EBA reporting itself, which is like, it's of course, infrastructural element that is basic for the EBA reporting. So it also will or did not change. So it was then it has entered into force on the end of the first quarter, and this is actually something that let's say should anyway have been done by all of the banks because it was announced way before. So I think this kind of IT and regulatory change makes a lot of sense, and nevertheless, it is something that also is well understandable. I write here in my header that there is a backdoor. I will come to that quite now. First of all, here a short reminder of what do we talk when we talk about leverage liquidity coverage ratio, which is like one of the important reporting measures, because when we look here at how it is calculated for level 1, level 2A, level 2B assets, divided by the net cash outflow. So when we look at the numerator factors and the denominator impacts, we see that there is a massive impact by the crisis on this liquidity ratio. And of course, it will not look better for all of you. I'm sure about that because I mean, you can weaken some effects of a crisis, but you cannot really simply make the crisis go away by mass tricks and not by measures, countermeasures. So what do we have here? It is the for example, for a numerator, we have a market value of liquid assets is radically reduced by declining asset prices. Of course, I've seen that galore, and also the increased volatility of asset values is quite difficult to handle because actually it's not only the regulatory limits that are bouncing all the time. So we will see here there is quite let's say a turmoil. You always must create this ratio because figures change so fast over the day that it makes a lot of sense to keep an eye on these kind of indicators. The same also here for the numerators. We have outflows. They of course increase because, for example, what we see at the moment is a rush to gold. There's a rush to other assets, and people leave the market, of course, and this is, let's say, very clear impact on all cash outflows. And here also the liquidity inflows will be reduced as loans become non-performing, which is our first start. The first thing that you think about in this crisis is, of course, the things that how can you pay when, for example, when a lot of your so-called cash income suddenly gets lost due to your business model, and especially the banks are the first ones to suffer from that, of course. So here is my backdoor. That's a short-term funding. That was a backdoor regarding liquidity that the regulators also addressed with two things. First of all, there was here the interest rate on all targeted longer-term refinancing operations was reduced even to minus 0.5% for a year. Then the banks may use also liquidity buffer during times of stress, but of course that doesn't come freely. These precautions is according to the law of CRR. Of course, here when you see here, there are three things necessary. There's an immediate notification necessary to the authority. There's also you have to prepare before you go there a liquidity restoration plan, how to come up to the LCR level of 100% back, and also the daily LCR reporting is necessary. Then you see, so you don't get rid of it. On the contrary, you really just have to live it very closely. Okay, so according here to liquidity, AMM, NSF, I will also have here a short overview over the EBA reporting per se, because that's what the people call so-called operational relief, and I will list some more measures even regarding this. The operational relief is, of course, a big part of the attitude towards saying, okay, you have so many things on your mind in this crisis and so many extra new things to do that the normal operations, of course, can't go away, but in this case, they will at least be a little bit reduced. A little bit, I say, because you see here, there are certain things not like LCR, ALMM. Also here, the so-called own funds leverage ratio, FINREP, and large exposure asset encumbrance reporting. There is a possible partial postponing, because there was an EBA recommendation towards the national authorities saying that you can, in certain cases, ask your local regulator for a postponement. Mostly what they do, for example, Germans or the British regulators, they give you basically 1 up to 2 months for certain reporting. Certainly not for the liquidity reporting, but for others they do. And so this is quite, let's say, little help. I would not say it helps too much, because actually it is something that is at the moment anyway, are the companies bound to do that. It is just all about, let's say, more operational activities that are connected to it. That means the reporting is done anyway, like usual, I know that, but when you have, for example, a lot of numbers that are not in the usual ranges, you have a lot of figures that maybe violate all the kind of normal business rules. It is more or less this situation that causes then even a normal reporting to be more cumbersome, to be more difficult, and lead then, of course, to let's say to higher resource needs and so on. So that is the real background of it. Real background is not that the simple report would cost you less, but it would simply the connected extra work with it. So this is also just a short sneak in. There are some other regulations and also some other yearly reports, for example, that have been suspended. I will give you, of course, some more insights here. There are some other measures for the operational, so-called operational relief. We have the first draft of CRR2, which is the completing implementation, called for now should be in September. It's not also fixed. That is an estimation of myself. They wanted to publish that already by the Q2, but it didn't happen, of course. And there is the fundamental review of the trading book. Standard approach is postponed by a year. Then we have certain market risk calculations in the Q1, so that is postponed by half a year to the Q3 of 21. That means only when certain thresholds are, of course, reached. But as we know, this is especially in this crisis that will, of course, kick in. So there's a reporting again also for a half a year postponed. We have here the EU-wide stress test that is postponed. We have the new data point model that was already written before. We have that still in. But for example, the cancellation of the Basel QIS exercise based on the June 2020 data also cancelled. So that was it already. I have still some things to say regarding this crisis. Now that it all gives you a lot of headache regarding not only, I would say, not only the things that disturb the business, but it is in general an insecure situation. So I think it's interesting to see what the regulator has. We have here postponements. We have also things that come earlier in place where they should help. We have things that kick or intend to be to help more in the diligence and let's say go more in direction lessons learned. And I think that is quite good to see actually that the measures that have been taken since the last crisis, or it was just a capital crisis, but in general terms, it helped already, I think, catch a lot of things that happen now. I think that is also, if you wish, it's a kind of a confirmation that regulation is here to stay, and regulation will always help to, let's say, get things done in a certain way on a certain frame. At the same time, I know that it is also sometimes too costly to make certain things happen on the regulatory sector. And I know that because I work since 15 years in that area. And I came from the IT, so I know slowly to understand the business processes behind it, but also the business, let's say, that has a certain intend to solve a certain situation. And right now, I think when we see the bigger picture, that means especially for capital requirement, we see now that it can be quite a good instrument to enable business. So right now, the problem is, of course, worldwide, people, whatever, lose their jobs, or people cannot pay certain things, cannot pay their rent or their credits, and these things will, of course, have a wider impact on overall. And the banks are the instruments that can give out or help people or help companies furthermore to reach certain things and to reach certain goals despite a situation like a crisis. And I think that when the regulators enable the banks to help the people or help the companies or help the economic sector, I think that then it makes a lot of sense, you know. So I think that this package is quite a very good sign. I also think that, for example, certain postponements will even be extended, especially when I think about the CRR3. You will see that right now they aimed at, I think, 2027. They will go now for 2028. My personal feeling, it will still take some years more to get there where they want in the end, because right now it is not really foreseeable that the crisis will, let's say, stop this year, because this was called a Reagan for 2020, but I think the impact will stay. And for me, I will try to keep you updated regularly now, to show also other aspects especially of the Basel related reporting, because actually when you see things like CRR, LCR reporting, or the CRR capital ratios calculations, these are things that require a very diligent look. You know, I have not even spoken about the internal or the so-called standard approach. I will do that maybe in another webinar soon, where I try to give you an overview over the impact of internal and standard approach risk models that can quite make a difference when you use them in a certain way for your business model. Okay. So I think I can finish now. I thank you for your time, and I think that I can give you also some answers to questions. If so, they are collected by my colleague, Tom, and I thank you very much for your time. Thanks.